Continuing a prior discussion forward, so in the previous discussion, we tried to understand why to use the price to book value metric over the price to earning for cyclical companies, heavy asset oriented companies, right? That is why, because price to book will give you a clear cut metric. If you're just investing based upon the price to earning and the price to earning is low and we invest into those companies, these are cyclical companies. They have cycles, their earnings have already reached peak. And at that point of time, when the price to earning is low, it means that EPS have already topped out. The cycle is bound to come down, right? But at that point of time, when the price to earning is low, right, the price to book value will be high. That indicates to sell off that stock. And the vice versa in case of when the price to earning is high, it means earnings are yet to come. Earnings are yet to come. They have gestation period, right? The break-even point has to come, right? And at that point of time, the price to book is low. So we concluded that always in case of cyclical companies, heavy industrial companies, asset-oriented companies like defense, aerospace, industrial, cement, reality, infrastructure, metals, mining, telecom, it's beneficial to use price to book. So always purchase such companies based upon price to book only. Or if you are using price to earning, reverse the logic. Always purchase such type of companies when price to earning is high and the price to book is low. Sell such companies when the price to earning is low and price to book is high. But that needs to be combined with the book to build. If the book to build is more than one and all these multiples ka theory surface, such companies are good. But even if all these metrics that we try to discuss and the book to build is less than one, it's not a good company, it's not getting orders, right? Further on, in case of banks as well, your price to book value is being used much more than price to earning. Or price to earning should never be used. Those who are valuing banks based upon price to earning are fairly wrong in the market, right? So banks ki book hoti hai, right? Ultimately, if we talk about the book of the bank is the loans. Bank ki book kya hai? Bank ki book is the loans. Bank gives loans and takes loans. ठीक है? Bank loan देता है और bank loan लेता है. And the interest rate on both these loans, the interest rate at which it lends you minus the interest rate at which it gives to some other banks is the spread, the net interest margin. And that's become a very crucial component of the final profit that the bank generates, right? So ultimately, जो बैंक की profitability है, जो बैंक की earning है, it is being defined by its book. अगर बैंक की book strong है, the asset quality of the book is strong, it's high quality book, the provisions are into place, right? Ultimately, that bank will be deriving a much better valuation. So ultimately, when you are calculating in the real world, you need not actually calculate the book value because that is something which the balance sheet has already done for you. Correct? In the balance sheet on the asset side, we already adjust the assets against the provisions, bad debts. So all that adjustment is being done already for you in the balance sheet. You need not calculate something physically or manually to get yourself confused. That adjusted book value, because anyways, if for example, I'm just giving you some baseline numbers, right? If the book value for the bank is 100, okay, book value of the bank is 100, right? Out of those 100, assumingly 20 people default, or 20% of the loans get default, मतलब कि 20 रुपए का default हो जाता है. The book value comes out to be 80. Assumingly out of this 20, 10 loans are secured. 10 loans are secured. Then बैंक को तो 20 का loss नहीं होगा ना, बैंक को तो बस 10 का loss होगा. We add back that 10 and we'll get 90 as the book value. As a broader view, though this calculated adjusted number is already in the balance sheet for the loans. You just need to take the book value per share and divide by the price. I've talked about this formula in the previous video, right? So again, every valuation is being based upon the book value for a bank. The bank might lend as a home loan, car loan, microfinance, unsecured, secured. The strength of the banking system or that particular banking company is being defined by the book value. It's being defined always by the book value. Because ultimately this will decide the earnings. Earnings come later. The quality of the assets come first because that defines the futuristic earnings. Correct? And that is the reason why the price to book value is being used for the BFSI space. Now the thing is, taking this topic ahead, for banks, you always use ROE and not ROCE. For banks, you always use ROE and not ROCE. The reason for that is, in case of banks, debt is a raw material. It's not a source of financing. For other companies, if they want to expand, if they want to diversify, if they want to grow its operations, they have two options as a source of capital, whether equity or debt. If they have money, they can use some retained earnings, they can use some internal accruals, they can raise equity or debt, right? But debt is not mandatory for them. If they want to use internal accruals, raise equity, they can go forward for that. But banks have to mandatorily raise debt, because bank का business ही यही है, they have to take debt and give out debt, and between it earns a spread, and that is nothing but your net interest margin as a percentage of total assets, right? So that is the thing. For debt is a raw material for banks, it's not a source of financing, and that is the reason you tend to use ROE, the return to equity holders, and not the return to capital employed, because capital employed talks about both equity and debt holders. उनके केस में जहाँ पे debt is not mandatory, you want the how much return the company is giving you, both from equity and debt point of view. But यहाँ पे the thing is, since debt is a raw material, we're excluding debt. And the same concept comes true in case of free cash flow to equity. In banks, we tend to use free cash flow to equity and not free cash flow to firm. हम free cash flow to equity ही use करते हैं and not free cash flow to firm. The same logic. Because free cash flow to firm is available to both the equity holders as well as debt holders. Whereas free cash flow to equity is only available to equity holders, and debt being a raw material and not a source of finance. That is the reason we tend to use FCFE. And again, if you talk about banks, cash flow statement is not so important for banks. So I've been stressing for every type of business, tend to look more at cash flow, not the profitability. But here in terms of banking business, cash flow is not important. Because banking business is much more based upon the quality of the assets it deploys. It's a money-making business, it's not selling money, right? Like for the other businesses, you are selling goods and services. The bank is not selling goods and services. So the operating cash flow or the investing cash flow or the financing cash flow doesn't make sense. It's not buying and selling goods and services. It's just buying and selling loans, which is the main activity of the bank, right? So वहाँ पे all these buying and selling goods and services, in सब का logic is not ideally appropriate in terms of banking businesses, because anyways the bank have to get interest on the loan that they have taken, and they have to pay the interest on the loan that they have taken. Ideally, if they're doing that, the bank will make good profit, and again the quality of the business will be justified by the bank's book. That's it.